In this video, we're going to talk about market value ratios. These are numbers that relate to the stock price. So stock price has a very important part in this type of analysis. So stock price is driven by investors. So if the stock price is rising, the implication is investors like this stock. They want to buy it. So the demand pressure drives the demand curve, shifts it outwards, and the stock price goes up. Now, what happens if the stock price gets too big? Is it possible for the stock price to get too big? And this happens frequently. So what happens is typically the stock price will get so large that some investors will look at it and say, well, really, I just don't think it's worth that much. And that could trigger some form of a sell-off. So if this number is too big, typically we're saying that the stock might be overpriced. If it's too low, it's underpriced. And of course, underpriced is going to trigger purchasing. So in this case, we're going to start looking at something called the market to book ratio. And it has the market price, as you see, divided by the book value per share for the company. Now, value stocks, those stocks that have lower prices for, we don't really know why, could have lower market to book value ratios. Growth stocks typically have higher ratios. But again, essentially what we're doing is we're trying to measure the attractiveness of this company to investors. Two kinds of investors, those that just want to buy for their portfolios, but it could also be for corporate takeover types of companies looking for something that's low in value that they can buy, something that's cheap to buy. So here we have an example real quick. We got Ryland's got 5 million shares, stock price is 108, book value is 50 million. So what's its capitalization? 5 million shares times the stock price of 108 makes it 540 million. And then if you divide the capitalization divided by the book value, we end up with 10.8 is the market to book value ratio. Now, one thing that I may also mention that I have seen this in research as the book to market ratio, which would be just the reciprocal of this. So in that case, if it's book to market, everything is backwards, right? So a very, very low number of book to market would mean that the market price, for some reason, is not right. And it's moving in the wrong direction. Maybe it's too high. So again, that's just a quick example of how to calculate this. So if we look at the mark to book ratio for Disney, we see that we're in the 3.5s. It has dropped. It's now down to 2.2. But we see that in general, it's fairly stable between 3.5 and around 2.5. But it does show a little bit of a decline here. So what could be causing this decline? Typically, it's not the book value, because in general, unless you're buying a lot of stuff, the book value will be declining over time. So in this case, the market value is, the market to book is dropping. So either the stock price is falling or the book ratio is increasing. And we did notice in this last year that there was a substantial increase in assets. So again, in this case, it could be the decline all comes from the asset purchase. We mentioned another ratio a while ago, something called enterprise value. And the enterprise value is what it costs to buy the company, pay off all the debt, and take the company private. So you can see here that the enterprise value for this company is growing steadily. So it has a very good growth of its overall enterprise value. So to buy this company, it's becoming more and more expensive. There are other valuation ratios, and one is the PE ratio. And I really like the PE ratio because it does give us a very close picture, or a better picture, if you will, of how shareholders feel about the company. Shareholders, the one thing that they're entitled to, a few other things, but one of the things they're entitled to is the profits of the company. That's earnings per share. So how much are the shareholders willing to pay to purchase the earnings of the company? So you have the share price divided by earnings per share. Again, if this number gets too big, it's implying that shareholders are overly optimistic about the company. That may trigger some form of sell-off. Too low, just the opposite is true. For some reason, shareholders just don't like the company. Typically, it's not earnings per share that is driving this relationship. It's the share price that's driving this. We also have two enterprise value ratios, one related to EBIT, right? So it's a form of a profit number, if you will. And then enterprise value to sales kind of gives us a little bit of a turnover number, so to speak. So the second version here, this enterprise value to EBT, your book refers to this and says that it's an improved version of the EBIT, or of the PE ratio. So PE ratio, a better picture of this, if you will, could be the enterprise value to EBIT. It'd be interesting to see how that would fall out in a graph, maybe. Enterprise value to sales basically just says, what does it cost to buy the sales of the company? Again, higher numbers means higher optimism or greater optimism. So here's the PE ratio of this company. As we can see, that it's fairly steady between the 20s and under 20, 15 to 20. Pretty steady PE ratio over time. Not much to gander at there. The enterprise value multiplier, you see, is growing ecstatically over the last several ratios. So we don't have a number for 15 because this is a change number. But these other ratios, see, it's fairly steady, and this last year, it just skyrocketed. So it's a much higher number now than what it has been in the past. The enterprise value ratios, again, with respect to sales, you see it's a pretty stable line here as far as sales. But as far as EBIT and profit, we see that there's again, at the end here, we see that there is growth. So this tells us that there is some optimism with this company. So again, that is just a discussion of some very quick market value ratios. They give us some indication about what investors think about a company, right? They only spend their money when they think they're going to make money. So that's the end of this video. Talk to you in the next one.